You know that life insurance is not an investment. So how do the insurance companies make money?
You are listening to Wealth Talks, where we talk about solutions, money, and other things that create wealth in your life.
You see, life insurance companies work off two different premises. Number one, they may be a stock-held company, which means that people invest in them, and the insurance company takes those investors' money and goes out and, in turn, reinvests it. Or they can be mutual companies. And in a mutual company, the insurance company takes the premiums paid on policies and invests it. Now, don't get me wrong, the insurance company and a stock-held company also invest your premiums, but they also invest the shareholders' money. And that means that they have to reward the shareholders before they do the policyholders. Whereas in a mutual company, any profits gained in the investment the insurance company is doing with premium dollars comes back to the policyholders because the policyholders really own the company.
That's right, the participating whole life policy owners. Because term policy owners, universal life policy owners, a mutual company can sell those type of policies as well. But those policy owners, they don't get to share in the profits of the company like the participating whole life insurance policy owners do. Big difference there.
So how is it that the guarantees in a mutual whole life policy are so much stronger than the guarantees in a universal policy?
Because the insurance company is basing this on what they are doing with their own money. The money that the insurance company is keeping, investing through their general fund. The profits of the company have to be shared with that, but the guarantee that they're providing can be stronger in that way. The guarantees that you find in universal life insurance policies, some of them do have guarantees, but they're usually very minimal. You look at the guaranteed values on the universal life illustration, oftentimes they don't ever outstrip what the policy owner has paid in premiums.
Well, many times the guarantee in a universal policy is actually a negative number because there's no purpose or intent by the insurance company to guarantee that that death benefit will be there for the client. That risk has been shifted back to the policyholder to make sure that they pay enough premiums or that their accumulated cash values is earning a high enough return to meet the cost of the ever-increasing coverage of death benefit.
So for an example, a recent universal life policy that we looked at here in the office, $120,000 of premium were paid over a number of years, 20-some years, I think it was. And then the guarantees, if you looked at the guaranteed values in that universal life contract, they never went above $120,000. It was always less than that.
Yes.
So there's always an expense there. You never come out ahead just based on the guarantees.
Now, even on the non-guarantees, the projected values in a universal policy are based on an average return of, say, the S&P 500 if it's an indexed universal life, or maybe the average return of a stock or equity if it's a variable universal life, or the average return of like the LIPOR or some other interest index if it's just a universal life insurance policy. So let's talk a little bit here and make sure that you understand the difference between an actual return and an average return. Remember, the IUL is basing their projections on an average return. So, John, why don't you explain how that can really affect the actual returns?
Sure. So an average rate of return versus an actual rate of return. Whenever you have a market that's going up and down, so it has some years of gains, some years of losses, you can average those gains and losses together, divide by the number of years, and you can get an average return. The problem is if you actually put money into that investment and it goes down, you need a higher return just to recover the loss. So
Yes.
if you had a 10% loss, you would need a higher gain to make up for that 10% loss.
11% to be exact.
11%. So with that,
And you're
happening-
working with less money because you've got to get an 11% on less money than you started with to make that happen.
right, because you already lost 10%.
Right.
So with that happening, the actual return that you get will be lower than the average many times.
So looking at indexed universal life policies, we often see an average return posted on there of about 8% because they say, well, that is what the S&P 500 has been able to perform, or some other index that they're referencing in their policy. Well, before me, I have the S&P 500 return calculator pulled up, and I have from January 1928 through the ending month of January 2019. So this is really current information, and the annualized S&P 500 return over all those years is 2.616%. Now,
Adjusted for inflation.
for inflation. Now, if we add in dividends with that, we can get a 6.537%.
Okay.
So already we realize that the average annual return that these policies are projecting their earnings on is inflated. It's greater than what the market actually performed at. Now, last week we were in Dallas, Texas, and my son Ben shared this example. If you want to earn 5% on say $100,000, and you're going to invest over 2 periods, if you lose 50% like many people did in 2008, then you're down to $50 to try to make back what you lost and to get that 5% return. Well, you can still get your 5% return. All you have to do is earn 60% the next period.
So from 100,000 down to 50,000, then back up to 60%. That would get you back to 80,000.
Now we're at $80,000. We're at the end of the 2 periods that we were going to invest in, and you've earned a 5% return.
Average rate
but
return.
you've lost over 10%
Yes.
of your original balance. So that's why average returns are not really conclusive and something that you can depend on. It's always your actual return. And that's what John Bogle always said. Nobody earns the market average. We always earn the actual. And that is really key to know. And so now let's look and see how mutual companies are able to provide such high guarantees in their policies
The whole life policies.
and to consistently pay a dividend that is above, takes better than average care of your money at the same time.
All right.
So with a mutual company, they don't have stockholders. They don't have shareholders wanting to see a profit or loss statement every 3 months. They're not invested in high-risk propositions. They are looking for long-range, steady investments. So primarily what they invest in is bonds. And they've got millions and millions of dollars to float this market for a long period of time. Let's go back to the S&P, for example. From January 2018 through January of 2019, the S&P lost 5.611%. How would you like to be in that market and having to report quarterly on that?
Yeah.
You're going to come out negative.
Certainly.
But the same S&P over a long period of time actually gives a 6.537 return.
with the dividends.
With the dividends. And so by stretching out their investments over a long period of time in bonds, 20, 30-year bonds, they can still be benefiting from a higher rate of return than someone that is having to invest in more volatile markets.
So they're not only are they getting the return on their investments, but they also have the mortality factor that they're working in.
Yes.
So that they can pay the death benefit to the policyholders that do die. And of course, they have that figured in. So if mortality is better then that's where some of the profit, can come back and go back to the policyholders that way.
Here's another thing, John, that I think everybody needs to understand, and that is, remember, the mutual companies are only investing premiums, whereas the companies that sell indexed universal life, they're also investing shareholders' money. So it's the shareholders' money and the premiums. So when the insurance company dishes off the responsibility of making a profit onto the policyholder in an IUL policy, that only makes the insurance company wealthier, which then goes to shareholders.
Yeah, the extra profits that they get by that.
Yeah.
That's interesting because in a mutual company, some of the mutual companies sell indexed universal life policies also, which actually the profits the company makes on that type of business would then go back to participating whole life policy owners in the form of the dividends.
That's correct.
So when you look at it, the insurance company has several different ways that they're making money. They have the factors that they built into the term insurance, the universal life insurance, which we've talked about before on this podcast. Universal life insurance is built on a type of term insurance. That's where the insurance is coming from.
Exactly.
And so when you put all of this together, the insurance company is making money in those ways, and then also off the investments that they're making long term. Now, with the indexed universal life policies, the insurance company is actually investing some of that money in various indexes. So how do they provide the guarantees, but they also cap the returns, the growth that you can get off of that? The way they do that is simply by buying options on the index fund that they're trading.
Exactly.
So when it's all said and done, you look at the bottom line. You could be better off if you really want to invest in that index, to go make the investment yourself, buy the options to limit your risk if you want to.
Sure.
And then take the insurance company out as the middleman. Now, some people ask, well, why wouldn't you do that with whole life insurance as well? Take the insurance company out from being the middleman. The answer comes down to the fact that you were talking about earlier. Insurance companies invest their conservative dollars in long term.
Yes.
So like the bonds. An average investor can't do that. We can't be in the market that long term to get all of those returns piling up.
Yes, and we don't have that big of a portfolio to float that many markets either. Mm-hmm. So, it doesn't make a lot of sense for diversification for someone who has a very small amount of money to diversify with. At the same time, Warren Buffett has always said that diversification is for people who don't know what they're doing. And yet that is what most people are advised to do, even with small amounts of money, compared to the millions of dollars that the insurance companies have to do just to buy and hold and stay in a market for a long period of time with a bond, mm-hmm. and to watch that bond mature over time so they can provide those solid guarantees that they pass on to the policyholders and participating whole life.
Yeah. And the guarantee in a participating whole life insurance policy is fundamentally different than a guarantee in a universal life policy.
Absolutely.
Because the guarantee in the participating whole life, that is the equity, basically, the part of your death benefit that you own. So the insurance company is no longer at risk for that money. Whereas with universal life, it's just in a cash fund.
Yes, you never own your own life insurance in a universal policy any more than you own it in a term. It's a lease of your insurance year by year. And if there's not enough money paid in premiums or enough money in your accumulated cash value, then the policy lapses. Mm-hmm. And we see this happen so frequently. Even the Wall Street Journal and several other major media outlets have reported on this, how many seniors are losing their coverage because the accumulated cash value has been spent on the ever-increasing cost of the coverage.
The term insurance,
the term insurance in these policies. So I know several companies have been sued, class action suits against them, because they promised this as a permanent solution to death benefit for these clients, and now they're finding out that there really wasn't anything permanent about it. So there's something else that we need to cover here so that you understand. A lot of companies now are taking a whole life insurance policy and allowing you to let the dividends participate in an index mirroring like a universal policy rather than just going to buy more paid up insurance in your own policy.
That's an interesting concept.
And we've talked to several people about that. And one of our clients is actually an actuarial scientist. And he referred us to some research. John, would you share that with us?
Certainly, it was an interesting. It's an interesting idea. Basically, what this allows you to do is to take your dividend for any one given year, the current year, and to invest that in the index, to tie it to the index just for that year. If the index does well, say it does 5% with this particular the particular example that I saw recently. So if it does 5%, then you would get your actual dividend that the company had paid you. That would go to your cash values. That part would buy the paid up additions.
Mm-hmm.
If the market did 0%, you would lose your dividend.
Yes.
Nothing would go to buy paid up insurance that year. So there is a risk.
So there's another way for the insurance company to make money in down markets.
Certainly.
And there's a cap on this too, just like there is an IUL.
And the cap on this particular example was 10%. Mm-hmm. If the market did 10%, you could potentially double the dividend.
Yes. Well,
then that would go to buy the paid up insurance.
And last year we didn't have a very good return. We had a negative 3.9 return in the market.
So if you had that option, you would have lost
your dividend. And so now when that happens, you lose the continual compounding growth. So really what this is offering you as a person who would buy this product, it's offering you to assume the risk that the insurance company is willing to assume for you just by paying you a straight dividend. And the only reason that the insurance company would do that is because they would like to avoid risk. That's what insurance companies are good at doing. So if you're going to gladly assume it, they're going to gladly give it to you.
There we go. So something that is good to keep in mind too is when you have a participating whole life policy owner or policy, the guaranteed values in every policy that we write are going to be that they will outstrip the premiums at some point.
Yes.
You'll be able to see that crossover point. Depending on age and health, it happens at different times. So you have to you look at the numbers, but it will eventually get to be more than what you've ever paid in premiums.
You know, we say that very bluntly, but that's something that you as a consumer need to be very careful of to make sure that your guaranteed cash values do become greater than the premiums paid, because we've seen many policies as we review them as a complement to anybody in the field that has a life insurance policy or is looking for one. We've seen many whole life policies where the guaranteed cash values never exceed the premiums paid. So although we would never write a policy like that or encourage anyone to purchase one, you need to make sure that that's not happening to you.
Exactly. Yes, it doesn't happen on all policies. The policy that does have to be designed correctly for that to happen.
Yes.
So you have this. You get this compounding growth, though, especially if you're looking at including the dividends of the whole life policy along with it. So you can picture this compounding curve growing greater and greater as it goes to the right. We're familiar with those curves. That's basically what's happening in a well-designed whole life insurance policy over time. So let's say that you need to access that money and use it for something. Well, if you did that on the universal life policy, you're taking out that growth.
Yes, you're taking out the accumulated cash values. It's designed to be mirroring something and earning a return. So now that return is up to you.
Yes. Now, with a whole life policy, you're only using that cash value as collateral to take a loan from the insurance company. Yes, you're going to pay interest on that loan, but you don't destroy that whole compounding curve. It still compounds there.
And this is a huge thing, because many people will tell you, why would you want to borrow your own money? And they're absolutely right, because Warren Buffett's father taught him the best way to build equity is to use other people's money, to leverage other people's money. And so when We're talking about borrowing money from a universal life policy. You are borrowing your own money. The return on the money that you borrowed now is completely up to you. The insurance company's not going to help you. Mirroring the index, that money's been taken out of mirroring the index was mirroring, or the equity that was trading. And so that return is completely 100% up to you to make that happen. In a whole life policy, like John said, when you borrow against your life insurance, you're actually borrowing against the paid up insurance that you own in that policy. So you're actually borrowing money that the insurance company from their general fund, and you are leveraging other people's money, like Warren Buffett says. And yes, you do have to pay interest on that money, but that interest goes to the profits of the company, which then drives dividends for everybody in the company. And you then get to use that money in any opportunity that you see possible where you could make more money.
That's right. And if you don't have that opportunity to make more money or to save more money, then don't take the policy loan.
So this is a huge difference. When people talk about why in the world would you ever want to borrow your own money? Well, in a participating whole life insurance policy, when you take a policy loan, you are not borrowing your own money. You're only using the cash value or the paid up insurance in your policy as collateral so that you can use other people's money.
That's right. So the whole life insurance becomes a great foundation of guarantees that you can build upon for your financial future. Unlike the chasing the return in the stock market or playing with it with an index universal life policy, trying to get some sort of protection out of it while still getting the growth, you really end up getting neither. You want that solid foundation of guarantees. And then if you have the opportunities, either in your life or if you want to go out and make the actual investment, if you have the guaranteed foundation of participating whole life insurance in place, you have the option to do both.
Well, many people are marketing the sale of life insurance as an investment, or they're marketing it as this magical pill that if you take, all of a sudden you're going to be wealthy. Life insurance is neither one of those. Life insurance is, like John just said, a foundation that gives you a solid tool to begin money management. And it's the money management that is going to create the wealth in your life. Because most of us tend to think that you can only use $1 once. But that's why Warren Buffett's father taught him about leveraging other people's money. That gives your money the chance to work more than one time without you having to go back and earn it again. And this is really crucial if you want to understand why it is so important to have the foundation of participating whole life insurance. Because unlike Warren Buffett or the other people that have made a fortune managing other people's money, you don't have people in your life that are lining up to give you their money to go manage. But with participating whole life insurance, you have a contractual guarantee that with a signature on a piece of paper, you can leverage other people's money.
Here we go. So give us a call at 702-660-7000 to see how you can use participating whole life insurance for your guaranteed financial foundation. If you have an existing universal life policy or other type of life insurance policy, we're happy to review that for you as well. Again, give us a call at 702-660-7000. You are listening to Wealth Talks, where we talk about solutions, money, and other things that create wealth in your life. Have a great week.